From New York City, for our viewers worldwide, very good morning. I'm Manus Cranny. These markets, whew, it's a relief. The PC could have been a lot worse, and our faith is restored in big tech and the equity story. Go on, Alphabet. $230 billion of equity value restored. We count you down to the open right now. Coming up in the show, those stocks looking to close out their best week of 2024. Alphabet and Microsoft deliver the blowout results. Redemption. And more inflation data ahead next week's Fed decision. We take a look at the big issue. We're looking ahead to Chairman Powell.
There's both a story here about the economy holding up very well with high interest rates, as well as inflation pressures being persistent. And while I don't think it's right to talk about this from the point of view of Fed tightening, I think the case for Fed easing here is pretty small anytime soon. We'll see where we are 6 months from now, but certainly the Fed's going to have to change its tune about its view that there's a fair amount of easing that's coming down the road.
Will Powell change the tune? Mike McKee is with me. We just had the latest inflation data. What will that do to the singing from Jay Powell?
I think Jay Powell's going to be singing something like Friday, I'm in Love, The Cure, but it's Friday and the news is good, and it doesn't change the narrative for the Fed at all. Look at all the threes on the board here. 0.3% for the headline and core PCE on a month-over-month basis, same as February, although you go out to 3 digits, and January and February were revised higher, and that's what absorbed most of the rise in the year-over-year here. And what happened yesterday when we saw the quarterly numbers, the March numbers come in as expected, so no additional inflation pressure during the month from what we have, which is good news. Then you take a look at incomes up 0.5%. Wages and salaries up 0.7%. More on that in just a moment. And spending stronger, 0.8%. The forecast was for 0.6. So that gets rid of that stag idea in the stagflation narrative some people were pushing yesterday. Take a look at the annual rates. They did go up a little bit. That is partly base effects and partly the fact that we saw these 3 months get revised higher, but they're still at least in the 2s area, which is better than the CPI numbers. You take a look at the market reaction, and the interesting thing here is we still have inflation. It's still sticky. It's not going anywhere. But the market's priced November back into the first rate cut. Swaps markets are showing a chance of the first chance of a rate cut coming in November and then December. But right now, we're back to where we were before yesterday's GDP report came out. And finally, I want to talk about wages a little bit more because this is a political year and this is going to come up. What we're seeing with wages is that they are rising faster than inflation, and that's important. People haven't sort of sensed that yet, but wages up 0.7% and the month, and the core inflation number and headline inflation number up 0.3. The white line there, you're doing better. So do people notice that? Does it have an effect on the body politic? Interestingly enough, we get University of Michigan numbers later this morning, which give us something of an idea about where we are with consumer sentiment.
Okay, Mike, thank you very much. Putting context around the consumer, the wages, and the PCE. Joining me this morning, put context around this, is Mark Haefele, UBS Global Wealth Management CIO, and Winnie Cisar, CreditSights Global Head of Strategy. Now, you're both of a consensus the rates will come. You're both of the view that inflation will loosen its grip. I think everybody's breathing a little bit of a sigh of relief this morning that this could have been spikier and hotter. Mark Haefele, good morning to you. What does this data do to the narrative that inflation may loosen its grip? I don't think it emboldens it, does it?
Right, but it's not like this data point suggests the next move by the Fed is tightening, which is enough on a Friday for people to take their eyes off the inflation narrative, realize that spending, consumer spending remains strong, and focus back on earnings.
So is that good enough for you, Winnie, on a Friday? Woof, mop my brow. At least we're not going to have a hike.
I think it is a helpful data point on a Friday, especially after we've had kind of a chorus of hawkish Fed speak and some data that has not looked particularly encouraging on a disinflation perspective. So the lack of a true upside surprise in this PCE read, I think, will be helpful for markets to get a little bit of stability, especially in the rates market, which is important.
Well, let's just talk about that. I mean, we had twos over 5%. We had quite a significant amount of supply that came to the market. So I'm curious to get both your views. Mark, you first of all, in terms of duration. I know that ultimately your base case is we travel lower. We hit 3.75%. So my natural question is, on the dips in price and the spike in yield, are you an incremental adder of yield on sovereigns? And does it leave you with a robust credit outlook?
Yeah, well, our preferred move in the space would probably be investment grade and, 5-10-year duration, more on the 5 side, because it's really hard to lose money when yields are this high. And from an investor's perspective. So when we had these debates about spiking rates in the past, rates were much lower. So I think now you have to take a little bit of perspective, because you can get these yields, you can lock them in, and they provide a lot of stability in portfolios at a time when there's a lot going on in the world.
Okay, I'll take you at your word. Hard to lose money at these levels. Winnie, with that in mind, we've Bob Michael here this week telling us to clip coupons, don't worry about the spread. And you're very much of the same view, which is keep on trucking, keep on clipping, keep on taking your yields in credit and sovereign.
Yeah, absolutely. We have moved back to a market weight or more neutral position across U.S. corporate credit, both in investment grade and high yield, because we like the yield environment. We think anytime Treasury yields in the long end are north of 4.5%, then you should be starting to add some duration to portfolios. But that barbell strategy, which has been very effective really for the past few years, I think will continue to serve investors quite well. And the carry that you get in U.S. investment grade and higher quality parts of high yield is very attractive from a long-term historic perspective. So I'm always a little bit reticent to say that it's hard to lose money, but we do think that the yield environment is very helpful for total return focused portfolio managers.
Haefele's survived a couple of drive-by cycles in his time. So with this in mind, then, let's cast forward to Chairman Powell next week. I mean, here at the House of Bloomberg, we would say, in many ways, his pivot before Christmas was the responsible for this Schleif, this rise in inflation. Mark, to you, do we need some kind of a hard pivot from Powell that the timing of cuts is going to be much more delayed than we are still hoping for? I think November's back on the slate at the moment by the swaps market. Do we need a hard pivot from Powell next week?
Well, you used a couple of foreign words in there that I didn't understand, but I think he's going to have to walk back. The market's already walked away from cuts in the near term, and it's going to be more about data dependent. And we think a cut is more likely in September, because we do see that the hikes that have taken place are starting to have a little bit of an effect. We note that consumers have spent a lot of their excess savings. And I think most importantly for us, the U.S. is an outlier compared to, say, Europe, where inflation continues to come down. So these things tend to move sort of in global cycles. So we just wonder how long the U.S. can really be an outlier with inflation continuing to go up.
Yeah, and that lies the point, Winnie, is that probably the view is that we had this pivot, this dovish pivot before Christmas. Here we are. We've got to hear what he's going to say next week. Does he need to reaffirm or at least convince the market that insurance cuts are on the way, even if they are back-ended?
Well, that's a great question. I don't know that the market is necessarily going to take Powell at his word. They certainly did in December when we had that very dovish pivot, which in our opinion was a little bit of a mistake. We had expected Powell and the Fed officials to remain very hawkish up until that date of the very first rate cuts. January was a more balanced, if not slightly more hawkish message from Powell, which was something that we anticipated. And the market really didn't seem to respond much to that until more recently. Now we have some inflation data that's supporting that type of narrative. And so now the market, I think, has swung too far in the other direction, pricing out rate cuts for this year. And that's just what the market's done for the past few years.
Okay. Winnie, thank you so much. Winnie Cisar, CreditSights Global Head of Strategy. Mark Haefele stays with us. A little bit more work to do on the equity side of the narrative in just a moment. Let's look under the hood. Ahead of the opening bell, Abigail Doolittle is with me. What have we got? Bit of tech?
Yeah, quite a bit of tech here. We have the shares of Alphabet absolutely rallying. The stock is set to add $230 billion in market cap on blowout results. This as AI has fueled 28% cloud growth. They also announced, of course, a 20-cent dividend and a $70 billion buyback. Microsoft also higher, not quite as much as Alphabet, but they beat on top and bottom line. Cloud grew by 31% for them, better than the 28% estimated. All helped out by AI demand as well. Snap up 25%. We've got lots of tech winners here, except for the last one. But daily app users rose 10% to 422 million. Current quarter sales could gain as much as 18%. There is an 8% short interest on this stock, so some of today could be a squeeze. And the odd stock out, Intel down 8.3%. A weak guide, Manus, there is weighing on those shares.
Okay, yeah, certainly brutal for Intel. Abby, thank you very much. Coming up, big tech strikes back.
Speaks to where all this money is going. The monetization's here. And that's why as a tech bull, you were sleeping very well going into this weekend.
Microsoft and Alphabet deliver blowout results. The conversation next on Bloomberg.
It just speaks to where all this money is going. It is going to a fourth industrial revolution, and you could debate economics and everything what's happening in macro, but the monetization's here. And that's why as a tech bull, you were sleeping very well going into this weekend.
Big tech rallies going into the weekend. The stocks of Microsoft and Google boosted this after their companies showed confidence in their AI spending and cloud computing. Mandeep Singh is with me now from Bloomberg Intelligence. Added into that, Mandeep, good to see you. Google, first dividend ever, and a pretty good buyback. The search engine is doing well, but it is about AI, and it's about the growing up of AI in these narratives, isn't it?
It is, and look, they are integrating AI with pretty much everything they have on the consumer side. And then on the cloud side, clearly they have the infrastructure to deploy AI for their customers, and that's what's driving the cloud growth. So really, what caught my attention was the fact that YouTube plus cloud is now 100 billion ARR. And when you parse through the numbers, I mean, YouTube is almost 60 billion in revenue. Think about it, growing at a mid 20% clip. That's quite impressive, you know. And cloud is separate, close to 40 billion. Again, it's right up there with Amazon and Microsoft. I would argue it's growing faster than Amazon at this point of time. And Microsoft clearly is the leader when it comes to cloud AI. But really, the numbers are getting better for Alphabet.
Have we consistently underassumed the underlying strength in Alphabet? I mean, YouTube, $8 billion in revenue, the strongest in 2 years. Live sports, I mean, it's stream after stream. Is it the silent sort of comeback kid here?
And I think what's most impressive is it's got both ads and subscriptions. So think of it as, you know, a Netflix embedded in it with almost, you know, 20 billion in recurring subscriptions, plus an ad business. And their engagement numbers keep getting better and better. And if there is a TikTok ban, I would argue YouTube is one of the main beneficiaries of that ban. So clearly, they're a juggernaut when it comes to the video consumption side of it, and it's showing up in the numbers now.
And just to square it away on Microsoft, obviously they have been seen as the leader in AI with OpenAI, et cetera. What nuance came through from them last night?
Yeah, so their AI workload revenue was about 7 percentage points of growth, a $4 billion run rate. And when you think about it, that business wasn't there 1 year back. So it's $4 billion in incremental revenue that has added to cloud growth, which was 31%, very impressive. And I'm looking forward to what Amazon prints when it comes to AWS, because they are the largest player when it comes to cloud, $97 billion run rate. Azure is $76 billion run rate. So clearly, Microsoft is growing faster, and it's closing in on that gap. but they are executing very well when it comes to AI workloads.
Snapping at the heels on the cloud, closing the gap. Mandeep, thank you very much. Mandeep Singh of Bloomberg Intelligence. Stay tuned to Bloomberg. We've got Pat Gelsinger of Intel, the CEO, joining the team at 11 a.m. Eastern. Still with me, it is Mark Haefele, UBS Global Wealth Management CIO. It's been a stomach-churning week for tech, Mark, hasn't it? Down $400 billion yesterday, saved by Microsoft and by Alphabet. When you talk to the clients, how much of Mag 7, how much more risk do they want to take outside Mag 7? How do you look about exposure to tech on the equity side?
Yeah, so I'm pleased with this week because I think it confirms some of our big messages, which are focus on quality in tech. There is a lot of focus on quality in stocks. There's a lot of tech in quality, and that AI is real. And I think, when you see tech companies beating expectations, adding dividends, that is they have very strong balance sheets. That's a sign of what we mean by quality stocks that can weather, if interest rates are a little higher and the economy is a little bumpy. So that's number one. But when you look into what we're seeing here in this focus on AI, these results were delivered with massive capex into the AI space. And so I think if you drill down further on the AI names and their ability to continue to post very high revenue numbers and profits, I think that's exciting as well.
It's interesting how the genius of Musk was rewarded with many promises, perhaps less detail. The genius of Zuckerberg was not rewarded, and sort of his future investments or his moonshots were indeed the reason why it dragged back on the stock. When you look at tech, Mark, do you look at very, very unique moats? Many people have spoken to me about the moat that is around Elon Musk, the believer in the dream that is Musk and that is Tesla. When you look at huge tech names, what is the most important facet for you when you decide, okay, this is where we want to be scaling up our allocation?
Well, there's certainly, call it a moat, I think, or recurring revenues. And, where are the choke points? All of this, for example, AI growth that, many companies, even outside of tech are just waking up to, at some level still comes down to chips and chip supply. That's something of a choke point still. So I think that remains exciting. So, you can never look at just one thing. It's a mosaic theory. But again, those companies that are showing the growth, have the strong balance sheets, getting the recurring revenues increasingly, I think that's very exciting to us.
I was quite captivated by what Dan Ives had to say earlier. He talked specifically about Microsoft, and I know you might not want to get drawn on an individual name. Masterpiece after masterpiece for Microsoft. But he talked about the general moment in time of where we are in the cycle, and I'd like to get your perspective. He talked about it being 1995 and not 1999. And $1 trillion worth of overall capex, additional capex to be spent by companies over the next decade. And I think that speaks very much to where we are in this cycle. What's your perspective of where we are? He says it's 1995 and not 1999.
Well, I certainly hope it's not 1999, but we have to watch out for that. I don't think it is for several reasons. First of all, I was just looking at my .com edition of Monopoly over the weekend, which I bought in '99, never opened, and all the companies that are gone to try and keep it real. But when you look through that, many of these companies did not have strong free cash flow, did not have strong balance sheet. It was about trading on clicks and eyeballs. That's one of the things that separates tech. Secondly, is this point about the capex that we see companies, across industries are deploying into tech, which I think is important. And then, what we hear from clients and consumers and we see in businesses, and I think increasingly we're seeing board of directors across businesses starting to ask CEOs, what is your tech strategy and what are you doing? And we see it in our own work, how we're using AI to speed up processes and save money. So, I still think that it is much closer to the beginning of this than the ending of this. And so, I haven't broken out the 1995 wardrobe like Dan did, but I think we're closer there.
I think Dan Ives has a couple of pink jackets he can lend both of us in various sizes and various shades. Mark, always great to get your perspective, you and the team. Mark Haefele, UBS Global Wealth Management Chief CIO. Coming up, morning calls a little bit later. Redemption for tech. Well, redemption for the bulls for now. BMO's Schleif joins me. After the break, we're going to talk about those blowout results. That conversation still ahead. Bell ringing, it's telling you two things. One, a relief in tech, 2.3% up on these equities. You're looking at the best week so far. You didn't think that yesterday when it was $400 billion wiped off the equity market value. But there is a palpable sense of relief as Microsoft and Alphabet and Snap really charge these markets higher again this morning, up 0.8%. Alphabet is the leader of the pack this morning. Roll it over, have a look at the bond market. There's a palpable sigh of relief that the PCE was not a higher scorcher. Plus 0.3% doesn't say that you've got this big wave down on inflation. It doesn't reaffirm some huge disinflation narrative, but what it does say, it could have been an awful lot worse, and we had quite a bit of supply to get through this week. So yields just dropping a couple of basis points across the curve. Let me take you through your morning calls. This is what we got from the analysts on Wall Street. First up, Stifel downgrades Caterpillar to a hold after earnings, expecting limited upside due to weakening sales growth. Next up, Bank of America downgrades Hertz to underperform, saying the first quarter results failed to alleviate liquidity and cost concerns. That stock took a battering yesterday. Finally, HSBC double upgrade for Snap to buy from reduced, seeing signs of broad-based recovery in advertising demand. There's no doubt about it. Big tech earnings have given us that relief that we needed in these markets. So futures are rebounding on that. We'll take you through the opening markets in just a moment, right here on Bloomberg. See whether the bid endures. Certainly Bank of America's big note from the Flow Show says the monopolistic hold that big tech has on these markets can endure until the real yield hits 2.5%. And we still got a little bit of mileage to go on that, but you are seeing a furious rally on some of the Magnificent Seven, not least Alphabet and, of course, Microsoft and Snap. We'll talk more about that in a moment. The breadth coming in there slightly as a laggard on the Russell, up 0.2%. The rest of the assets you've got, again, the dollar is slightly better bid this morning. You're looking at the euro down by 0.2%. Yields tick lower. The PC was not a lot hotter than the market had estimated, at plus 0.3% on the core. So there was a sense of relief, really, in the bond market. And crude is up by 0.7%. I can tell you, we've managed to put on just over 2.5% this week. So while some of the geopolitical tension has eased out of this market, there's still tension in that oil market. So just keep an eye on that. Key time spreads suggest that we have a robust market. Tech stock, it's the only thing that we've really talked about for the past 48 hours. And Microsoft posting their sales and their profit on strong demand was a nice beat for them in AI. And it was a similar story for Alphabet, as we've been saying. AI fueling the crowd growth. Ed Ludlow is with me on the tech track. Ed, I mean, these are pretty stunning performances by Alphabet, putting back on $230 billion worth of market cap. So that's a nice relief to Meta.
It's a nice relief, and there's clearly a clear story across Alphabet, the parent of Google, and Microsoft, which is all of the investment in AI infrastructure and R&D is manifesting itself now specifically in top-line growth for their cloud businesses. Alphabet, when I spoke to the president, CFO, and CIO, Ruth Porat, on the phone, she was very clear. They are seeing AI solutions make a meaningful contribution to cloud growth. But Alphabet's an interesting one. There is actually some frustration on the street about how little guidance they give and granularity. The stock's up 10.5%. Let's see where it closes. It will close at a fresh record high, very likely. But if you get above a gain of 12%, you're talking about the biggest jump since 2015. So it's a big response. I'd probably say, Manus, and I think you were discussing this with your guests earlier, the first ever dividend probably is a bit of a sweetener that's helping that stock move. Microsoft more muted, up 2.6%, and yet they gave us the granular detail. 31% top-line growth in Azure Cloud. 7% of that growth came specifically from AI products, up from 6% contribution in the prior quarter. So we have more size and scope with Microsoft. We know, basically, going back to basics, that when we're talking about generative AI, in other words, generating text, image, or video from a prompt, they're selling that as real product. And that is, in the enterprise use case, showing up really well in cloud for both of these companies. One other point on Alphabet to jump around between the two. I think there's a lot of confidence that the core search business is resilient, but YouTube is a real bright spot. And if you take YouTube in aggregate with clouds, the commentary was that the run rate on revenue is $100 billion. Executives on the call very much framing this, that if the search business matures, don't worry. We've got something called YouTube alongside our cloud business that's going to bring that future growth. Interesting moves on what's been a pretty crazy week for technology earnings.
And don't forget, Ed, if they ban TikTok, you've got your YouTube. Even more music to everybody's ears. Ed, thank you very much. Ed Ludlow on the tech track. Stay with that, because we've got Snap shares surging this morning as well, after the social media company posting a beat as well as a positive outlook following their ad revamp. Abigail Doolittle has the detail. Wow, 25% up.
Pretty incredible, heading toward the best day since February of 2022. Now, it had been down significantly on the year into today, so making up some of that lost ground. The quarter that was okay. They did beat adjusted earnings and revenue adjusted earnings ever so slightly, basically flat, a profit as opposed to a loss. Revenue, though, was about 7% better. But what folks are really honing in on is the fact that their revenue projection for this quarter expected to grow by 18%. And they're really saying that this has to do with their revamp of their digital advertising business, gaining popularity with marketers. In addition, also positive is the fact that Snap daily active users rose 10% to $422 million. So this social media company getting a little bit of a break. One thing I would point out around this monster gain, right now up 28%, there is an 8% bearish short interest on this stock. So today's move could be a bit of a squeeze.
Okay, certainly a snap back there, excuse the pun. Abby, thank you very much, Abigail Doolittle. So Intel, they have had lackluster sales outlook for the second quarter, signaling that the boom in AI technology is diverting business away from Intel's traditional PC chips. This is a considerable headwind. Alex Semenova is with me to detail.
Good morning, Manus. Well, Intel is clearly the outlier today among the tech names that gave a disappointing forecast for the current period, highlighting its struggle to return to the top tier of the chip industry. Sales in the second quarter will be $13 billion, below the estimated $13.6 billion, and profit is on track to be just 10 cents a share versus a projection of 24 cents. The company's first quarter results were largely in line with expectations, but it's all about guidance this earnings season, and Intel did not deliver. It also failed to meet demand for processors used in its new AI-enabled PCs because its packaging facilities failed to produce enough components. CFO David Zinsner acknowledged that the business was slower this year, but he said that he expects an improvement later this year. Taking a look here at some of the analyst reactions, Cowen said that there is no getting around a tough set of results. And then Stifel said that this year should mark a bottom for the business, but it's unclear the pace of the climb back up. Shares are down here nearly 12%, the worst day since January 26th. And the stock was already down 30% year to date heading into this report, making it the second worst performer in the Philadelphia Stock Exchange Semiconductor Index. Manus.
Alex, thank you very much. Bloomberg's Alex Semenova there. So big oil, big disappointments. Exxon and Chevron reporting their first quarter results, and they both missed expectations. Now, the weak results are due in part to the fall in natural gas prices, lower refining margins in the first half of the year. Isabel Lee has the detail.
Hey Manus, big disappointments indeed. We have Exxon and Chevron both reporting lackluster results. So Exxon posted an EPS that was 13 cents lower than Bloomberg's average estimate. And this is despite the surge in crude output from its development in Guyana. So shares are now edging lower. Chevron, meanwhile, this is where some confusion is happening because when it opened, shares popped and now it's edging lower. And I think it's because revenue forecasts fell short, but EPS surpassed expectations as well as oil production. So both those results come amid a shift in investor expectation that favors oil production growth. And that, as we know, investors are taking advantage of concerns of global supplies, and this supports crude prices. One bright spot for Exxon, though, was the cash flow. It came in at $14.5 billion, so this is $1 billion higher than forecast, again boosted substantially by its Guyanese production. So for the past 2 years, both of these firms have really enjoyed unprecedented profitability in their histories as energy prices really surged to record profits. But since the onset of the war in Russia and Ukraine, oil and gas prices have largely stabilized, and now shares are edging lower still. You have Exxon down 3%, but year-to-date it's up 17%. Chevron year-to-date is up 11%, Manus.
Isabel, thank you very much. Isabel Lee there with the very latest on big oil. My next guest weighs in on the recent market volatility, saying this: a 5 to even 10% pullback in stocks is a normal course of events after the exuberant rise of October 2023 lows. And we are seeing a recalibration going on in stocks and bonds. It is Carol Schleif. She joins me now, CIO at BMO Family Office. Carol, thanks for being with us. I mean, we haven't had a 5% drawdown. We've had nowhere near a 10% drawdown, and yet we're dealing with two-year rates above 5%. So is the equity market still set for some kind of a day of reckoning relative to the bond market?
You don't necessarily need to have another day of reckoning. We did see a 5% sort of pullback, and then you had interest come in because I think markets really are trying to deal with that tug of war between looking at the short term and then understanding that we're in the midst of a major secular trend here where we're reinvesting in infrastructure, we're reinvesting in a lot of things to put productive capacity into the United States. And so investors want it to happen in the short run. They want to see it happen today. And yet there's a lot of themes that are supportive of that underlying growth rate.
And the whole premise here is that the rates, as you say, we don't need another dramatic day of reckoning, and that's not necessarily what I'm calling for. But I'm drawn to what Bank of America had to say this morning, which is this monopolistic field to the Magnificent Seven, to that top echelon of tech, can continue until real rates test 2.5% to 3%. And there's still a country mile to go until we get to that level of real rates.
Right. We do think that we've broken the back of the zero interest rate or the negative interest rate environment that we've been in for the last 10 or 15 years. And we would agree with that move towards real rates of 2 or 2.5%. You're going to see a lot of volatility in the markets as they adjust to, the interest rates not coming down as fast, the top line rates not coming down as fast as the Fed would like to see or anyone would like to see. But that's because there's so much underlying growth in the environment, and having a bit of inflation, once investors remind themselves or understand that having that bit of inflation in the system is actually pretty healthy from a long-term standpoint, because it allows for some modest wage increases, it allows for pricing power, it allows for a lot of things. But this adjustment we're in the middle of means it's kind of confusing anytime you go through regime change from 0% rates towards 2 or 2.5% rates.
Yeah, I mean, the theory is that we're nearer the end of the regime change and perhaps about to see some kind of reversal of that regime change. Were you heartened by the wages component of the data today? I mean, the PCE was almost like a relief in that it could have been an awful lot worse, but the wages component was strong, up 0.7%, far outstripping that of the inflation narrative. The takeaway and the consequence of that for you from an equity perspective?
We do expect that you'll see a somewhat of a softening in the wages component, especially by the end of the year. But overarchingly, there's a lot of health in this economy, and the PCE was pretty indicative of that. We've got growth coming through. We're not seeing a big tail off in that. We've got healthy employment markets. You saw it in the unemployment claims earlier this week, still being at a very muted level for this far on in an expansion area. And I think those underlying trends of reshoring, friendshoring, having the data center the data center draw on the grid, the need to improve the grid. There's tons of stuff going on in the country here that really make for it an important secular theme. And so investors really have to figure out an anchor to that new level. You've even seen it in the housing market. When we get the mortgage rates down below 7, now people are anchored to a higher rate than they were a couple of years ago, and you see activity pick up.
And you're seeing some value stocks do sort of mightily well, even in this higher rate regime in a relative sense. The likes of GE, et cetera, sort of seeing a couple of these ETFs with high value components in it. So that's about what, having gotten through, or perhaps not facing the same kind of refinancing cliff as many people had perhaps worried originally.
Yeah, well, I think a lot of companies had some fixed rate debt involved. And the unique thing about this market is you're seeing it even sector by sector. It's tough to paint a whole sector with a broad brush. It's really an active managers kind of market where it's stock by stock, company by company. What does their balance sheet look like? What is the interest rate environment on their own unique balance sheet? What are their needs for capital expenditure? And so it really is an interesting market. And we would push back a little. It's not just the Magnificent Seven carrying the market, or the Magnificent 10 or whatever. There's a lot more breadth in the market, and there's people looking for who are the second and third tier plays, not just the makers of AI chips, but who are building the data centers, who are facilitating the hooking up to the grid, who are facilitating the water rights. You know, there's a lot to consider here.
Yeah, as you say, it's about trying to think a little bit more broadly in terms of what the entire chip story is. Carol, thank you so much. My guest this morning on All Things in the Market, Carol Schleif. Coming up on the show, we'll take a deeper dive into Exxon's disappointing showing in the first quarter. More on the big oil move, but I just want to show you there is Exxon down 2.5%. Intel extending its decline to 13%, the biggest drop since July 2020. This is how tech worlds and chip worlds divide. Check in on the Exxon stock now. The share is down. The company missed on their earnings per share estimates. The oil giant said it expects $60 billion acquisition of Pioneer Natural Resources to be approved by the end of June. Joining us now is David Withey. He is the reporter tracking this story. So if I look at the results here, what was it that's proved the flesh wound, if I can call it that at all?
Yeah, probably if you really had to point to just one thing, it might be the refinery maintenance schedule that was a little bit more heavy, that sort of dragged down the results. And sometimes that can be hard for analysts to predict. But then there's also some non-cash charges that also were hard for the analysts to model. And so that drove a lot of the miss. And then just from the earnings call that we just got off of, there weren't a lot of really new excitement or fireworks to get investors excited about. And so that's kind of driving the overall drop in the shares right now.
CEO says cost cuts to hit $15 billion by 2027. Just tracking it on the T-Live for anybody that's tuning in. It is all there, the exact details that you need. Look, if the presumption is the Pioneer deal goes through, that gives them 15% of the overall oil production in the Permian. Is that transformational or is it incremental and all in the price?
Yeah, it really depends on what they do with the Pioneer production, because they've said that they want to actually grow the production from Pioneer. A lot of the historical trend has been, though, when big M&A deals happen, that the company will cut the production. So the question out there is really whether this will actually raise production or not. And Exxon says it will. And so investors are hoping that will be the case because they're more open to oil production growth happening in key places like the Permian and Guyana.
Do you think it's OPEC's work and a tighter market that has induced the Permian and U.S. production and exports to a manageable level? I mean, can we all coexist? You know, because we've gone through the Permian racing to produce irresponsible leverage, etc. We've learned our lessons of the past. Here we are at $90 oil. How healthy is that? How much is the Permian dependent upon the goodwill and the constraint of OPEC+?
It's definitely helped. There's no doubt about that. The market, the oil market in general, is healthy right now because no side is really going crazy with production growth, and so it seems that if all areas kind of go with this sort of moderate growth, then it sort of helps things. And it's a different mindset entirely for the Permian producers. Saying that, I will also note, though, that Chevron and Exxon are both stated that they plan to grow production by 10% this year, and that's about twice as much as what most independent E&Ps have said. They plan to grow about 0 to 5% in the Permian. So, that's about the one outlier. But generally speaking, the Permian is going moderate in growth, and that's mainly to send profit back to shareholders. So as long as that continues, it seems like it stays a relatively healthy oil market globally.
David Wethy, thank you very much. Let's see what OPEC Plus do in June. Of course, when they meet in Vienna, they can always act before then. Unlikely, as it seems at the moment. Sector price action for you. Abigail Doolittle is with me with the details. Abby, what have we got?
Well, we are looking at the S&P 500 up about 0.8%. Not surprisingly, a lot of this has to do with Alphabet and Microsoft. The best sector on the day, communication services, up 4.8%. Yesterday, it was down on Meta. Today, it's up on Alphabet. Tech being driven by Microsoft. To the downside, though, you're just talking about Exxon and Energy down 1.5% on the day, along with healthcare, utilities, and financials. On the week, though, we are looking at the best week, most likely, potentially, of the year. And this is being driven by all 11 sectors higher, the best sectors. Tech, discretionary, and then interestingly, utilities in there, up 2.1%, even with yields high. And then there is communication services. So mainly those three mega cap tech sectors, Manus, they're a big part of this week's gains.
They are just plowing ahead. I'm just looking here. Google, the parent of Alphabet, over $2 trillion. So fourth company in U.S. company to hit that milestone. Hello, Apple. Hello, Microsoft. Hello, NVIDIA. Abby, thank you very much. Coming up, market moving events. Let's set your diary and give you your details on Bloomberg. We've gone from a berating of tech yesterday and $400 billion wipeout to a veneration of Alphabet, to Microsoft, which is about the delivery within tech, within AI. And if you can give us the detail, then you are rewarded. Just look at the $230 billion being reapplied to Alphabet's valuation. What else is driving this market higher? It is the wages number within the PCE, plus 0.7%, way ahead of core PCE at plus 0.3%. Therefore, real wages are rising. Hence the reason why you see this perhaps resilience a little bit in the Russell. So overall, you've got equity markets giving you the best week of 2024. Have we already chowed down on the fact that we are facing over 5% on the very short end of the yield curve at over 5% at one juncture in the two-year paper this week? The auctions went fine. Your trading diary for you. We will get the University of Michigan sentiment at the top of the hour. More consumer data on Tuesday. We're going to get the Conference Board consumer confidence numbers. Have those real wages transferred through to spending and hope. Chairman Powell speaks on Wednesday. Is there a pivot to be had there? Then it's all about Apple. We know they've had a tough time in China. We had that detail this week, so we'll get a little bit more exacting detail on Tuesday. Friday, we will get the ISM services data. That is everything that you will need to know in terms of the services component and inflation. That was countdown to the open. The tech market very nearly broke yesterday. It reasserted its strength and conviction, let's say. That's it for me and from all the team on Countdown to the Open. The rest of the Bloomberg team will take you through the rest of your trading day. A very good morning from New York. Thanks for being with us.